Well, hello, everyone. Thank you for taking time out of your day and joining Hyphen Solutions and HMS Cornerstone for Hyphen's July 2020 webinar. Today's topic, top accounting trends leading builders that are leveraging to get ahead in 2020. We are joined by HMS Cornerstone's Stuart Siegel, along with Hyphen Solutions Division President for Home Builder, Stephen Candy. Stephen, I'll turn it over to you.
Matt, can you hear me okay?
We can, thank you.
All right, good, perfect. Good morning, everyone. Thanks for having Hyphen today. We're very excited. We love partnering with Stuart and his team at Cornerstone. We've had a great long-term relationship, so we're excited to be part of this webinar today. I always like to leave a quick introduction. If there's any questions, feel free to email myself or Matt, as well as Shane and Karen are two of our key BRIX managers on the BRIX program. So very excited to be here today. I did want to take a couple minutes just to give some background on Hyphen and kind of lead it into Stuart's conversation today on accounting and ACH and things of that nature. So just a real quick background on Hyphen Solutions. So we have 20 of the top 25 largest home builders in the U.S. running on BillPro. We're viewed as a trusted home builder network, unifying the supply chain, the construction supply chain. And really what that means is with all of those builders that we have running on BillPro, we have a vast network of suppliers that communicate real time, collaborate, communication from the field to the suppliers. And we've really kind of worked on making that as good of a process as possible. And we're continuously getting better at that and working with both our builders and suppliers to make it as efficient as possible. So really the goal is to have data entered once, if you will, digitized and into or onto the Hyphen network, and then allow communication between the suppliers and the home builders. And so if you look at this, I like to use this slide here, the single source of truth. At the bottom there, you have field operations data. I like to think of that as BillPro, our scheduling tool in the marketplace. And then SupplyPro is what the vendors use across North America to communicate, again, real time with their builders. And then over the last several years, we've acquired several ERPs, BRIX on the back office accounting data. And really what that allows is what we call a single source of truth, but everyone's on the same page. All the data goes seamlessly, real time, between the accounting team at the builder, between the field operations team through BillPro, and then to their suppliers through SupplyPro. So again, that single source of truth, get the information onto the network and then allow it to flow freely from the builder to the suppliers. And if you go to the next slide, you can see just how many suppliers we have across North America and the major markets. Unfortunately, I do not have Canada on here, and we need to add that. We have several of the largest Canadian home builders in North America as well. So Toronto, Calgary, Saskatchewan, Regina are all markets that we focus on as well for Canada. For this purposes, though, this is just the U.S. map, 13,000 suppliers across North America. And as Stuart goes into some of his accounting and whatnot, I want to take into consideration or have you guys think about a new product that we've introduced. It's called Wallet, but really it's about security and safety of paying your trades in a timely manner, but also reducing costs associated with that. And primarily one of the things that I'm seeing is actually the focus on fraud. So over the last couple of weeks, I've talked to two of our large national builders, and a lot of their divisions are being hit up with phishing. The old scam, COVID-19 is the effect of COVID-19. We're no longer accepting checks. We're going to change our bank account, and here's our new bank account or whatever, right? And so we're seeing just a ton of the builders hit with these fraudulent emails and phishing scams, and really Wallet addresses that, right? So one of the things that the Wallet really allows is that double authentication and confirmation that it is truly your supplier asking that, and it's validated, and reduces that risk of fraud. So we're very excited about this new product as it relates to BRIX and the three key benefits there. So we're very excited about it. I wanted to bring it up today in context to what Stuart's going to be talking about with regards to accounting and certainly ACH. But we work with our builders and promote to them and suggest, that they pay their suppliers in a timely manner, which drives better behavior and a better long-term relationship with your trade. So we just see ACH, electronic payments, and the reduction of fraud, the cost savings and time savings is just instrumental as we go into the latter half of 2020 and into 2021. Stuart, that's all I had. I just wanted to take a couple minutes to do a quick introduction. Any questions you had for me, or as it relates to what you're going to be talking today?
I think we're good, Stephen. All right. Well, good morning, everybody. I'd like to thank you for joining us. I'd like to just talk for 10 seconds or so about myself. I have been around for a very long time in the industry, probably almost close to 40 years, I have to admit. I don't really like to say that out loud. I come from the accounting side of the world. I was originally with Kenneth Leventhal and Company, and then I ended up at Ernst & Young when they bought KL many years ago. So I've been around a long time. I've specialized in real estate systems and in property management systems. So that's kind of my background. So today I want to kind of talk about some trends that I see in the industry, and I'd like to just share them with you. Now, when originally Matt asked me to speak about this, he said something about accounting, and I said, well, I don't want to bore everybody to tears. So I'm going to give 3 case studies of things that we have seen from the business aspect and how they have improved the bottom line. One of the advantages that I have as a consultant, I get to look in a lot of people's backyards, and I see a lot of good things that people do, and I see a lot of things I wouldn't recommend people do. So today I'm going to share some of those with you without giving away any trade secrets. So before we get here, I'd just like to make a couple of comments overall, and my presentation will be available if you want it afterwards. I'm going to close this window. Nope, don't cancel. So home building, since I have been around for over 30 years, has always been considered a very low-tech industry, and hasn't really changed that much until just recently with the whole coronavirus. Many years ago, one of the owners said to me, hey, Stuart, your technology is nice, your back office system is nice, but we don't really care about it. We're going to build one house, one nail at a time, no matter what system you put in. And there is a lot of truth to that, but I do think in this day and age, we've come to realize more and more that technology plays a role in our lives. We see it every day. I like to say now that we live in an Android and an Apple world. Everything is at a handheld and at our disposal and instantaneous to us. And I think home building is moving in that direction as well. I think a lot of this has changed now with the global pandemic. We at Cornerstone, if you had asked me on day 1 of the pandemic and people closing down, we thought the 10 of us who make up Cornerstone would close our doors and basically wait until it was done. And we didn't know how long that would be. But we are actually busier than we have been in years. We have builders calling us, and they want to pay their vendors through ACH or EFT, electronic fund transfer. We now are working with some of our builders who are trying to do virtual tours of their model homes. So even if people do a site visit when they go home, they can do virtual tours as well, show their friends and family. We see more and more option selections are being done online than we've ever seen in the past, where buyers want to sit in the comfort of their living room and they want to make the selections. So they need to understand their choices. They need to understand their pricing as well. Sales agreements have been for years. People have been using DocuSign, but we have 3 engagements currently setting up DocuSign of builders who've been very reluctant to use it in the past, but now recognize the value of it. More and more, too, we are being asked about scheduling. People were very lax in their scheduling systems, and now it's very important that they understand their milestone dates, and it's also tied to the buyer satisfaction. We are also keeping track more and more of variance purchase orders, punch list items, those items, all of these things where an owner and a builder can take a look in the back office and get a feeling for what's actually happening in the field, where before they would actually go out on site and take a look at them. Now, what we're going to talk about in my first case study has to do with margins. And this is something that we've seen for a while now. And one of the questions we're asked, how much money are my margins actually earning? What is the return? And how are we accounting for them? Now, what we have done in a couple of cases, and we started this out a couple of years ago, and since then we have worked for a half a dozen national builders who've wanted more information about their options, who's buying them, and how much they're actually making, and the impact that it has across the board. So we go in on day one and we extract data, and data is the key here, and that'll be my underlying theme. Your data tells a story to people like me, and it should tell a story to people like you. And whether it's data coming from the prospects, the sales, purchasing and estimating, operations, accounting, or customer care, all of this data tells a story when you weave it together. So today's presentation is going to deal with a couple of items, or three items actually. I'm going to talk about gross margins. I'm going to talk about buyer profiling and purchasing habits, and I'm going to talk about buyer satisfaction. Once again, these things come from the bottom line, how to improve it, and how do we use your data to get there. Now, on the gross margin report, I really believe where a lot of builders come up short or fall short is they don't recognize it's really a team sport. It is not up to the sales department. It is not up to the purchasing department. It takes all members of the team to come together and to work towards a better gross margin. So here I state that stakeholders, they need to come together to work for the business goals and objectives. And I think it needs to be very clear about what the strategic business plan is and what everyone's role is in that overall plan. And as we move more and more into a world of technology, I think it's important to come up with some key performance indicators, aka KPIs, and some milestones as well, so people know how they are doing and how they can be judged over time. And I think this is very important, especially this day and age where everything can be moved down to the handheld. And I think ultimately, at the end of the day, I think this should be somewhat tied to a compensation package. We at Cornerstone do not get heavily involved in compensation packages, but I think if you reward people for doing an excellent job, they'll work even harder, and I think it's very important. So we do highly recommend that people take a look at compensation. Now, we usually start out looking at original pro formas. We look at sales volume, product mixes, and in our example, and for this particular client, we started looking at a new community. We were looking at all of these items, what product mix they were putting out there, the cost of land, cost of directs and indirects, sales and marketing, and so on and so forth. We also went out and we wanted to identify who in the organization would be held accountable and responsible for any of the business units that we deal with. So as we saw earlier, we knew who was in sales, our land, our indirects, our directs, our warranty. Who are those people and how are we going to measure them? And once again, the criteria for doing that. One thing that we have recognized across the industry, there's really no definition of gross margin. So each individual company and team has to define what that is and what components make it up. Now, I've been a consultant for many years. I've done a lot of work also in property management and in asset management. And for those of you familiar with NACREIF, it has to do with those pension fund advisors. They have come up with an industry standard for defining what profitability is and how much you are making in returns for a building. So that way, if you want to compare building A to building B, you have an idea because everybody uses the same standard in judging. But we don't have such a thing in home building, so everyone has to make their own decision. As a consultant, when I go in and I talk to a new prospect or a new client, one of the things I need to understand is how do they arrive at gross margin and what's included and what's not. Now, some people will include land allocations and vertical construction and indirects. Some people do not. Some people will have sales and marketing, other such items as that, and once again, so it's important to understand. Somebody asked me years ago, gross margin, Stuart, what do you think it is in the industry? And I said, well, I can tell you that my clients have told me it's anywhere from 8% to 55%, depending on who you talk to. And that particular client almost fell over, and I said, I know, but it depends on what you throw in, what's in the bucket and what's not in the bucket. So I think it's important to understand that. In my case study here, we followed a client who had purchased some raw land, and they subdivided it into residential, also some commercial. We assessed the market. We looked at a buyer profile to understand who the buyer was and what they were doing. We looked at our plot plans, and we looked at overall our pro formas to see how we were going to do. So I put together here as a mock pro forma that we did. And essentially, we took it for an entire community, phase one, and we said we spent about $4.5 million for the land. We added some developments, indirects, directs, and closing costs. And that is my first column in here, and it said basically I'm going to have a 23% gross margin after I take my base revenue and my option revenue. I'm going to be left with about $7 million. Now, in this particular phase, there were roughly 100 homes. We did some easy math. Some homes are worth more than others, but for this presentation, we just made it simple. And we divided everything by 100. And you can see this is what we were expecting to get, and we were going to have a return of about 23%. Now, one of the key things on the right here is which departments were going to be held accountable and responsible. I've identified land acquisition, land development, site supers, purchasing and estimating, and accounting, and sales and marketing. So it's important for everybody to understand their role when it comes to gross margin and what it looks like. For those areas that tend to be the most fluid, it is not purchasing and estimating. In my experience as accounting for all these years, if I ask somebody how much windows cost from purchasing and estimating, they can probably tell me within a couple of dollars. If I go to the site supers, they have an idea what it costs, but the problem is they don't know how long they're going to be around. So they may be budgeting for a community that'll be around 18 months, but it turns out they're there for 30 months. Sales were not as quickly. So all of a sudden, those indirect costs begin to grow exponentially. On the land development side, to me, that is usually the most fluid area. The land was purchased, and we have to do some additional on-site work, and people are not very good about judging that, and that tends to be where the margins get eaten up, in my opinion. Once again, in my scenario here, in my pro forma, I thought I'd end up with about a 23% return. Over here, I take that and I apply it against one of my plans, which is a 1650A. I take that information and I come down to a 23% return. And this is part of my pro forma. So what I do then is I have my original pro forma that we just saw, but I am now going to judge it, my margins, at milestone events. I think this is very important. I've been talking about this for a few years. As I said, I've done this for 6 national builders for different reasons. I've done it for some regional and smaller builders too. And I've encouraged them to look at the original pro forma they expected, to look at their margins again when they release a house to construction, to look at their margins when they sell it with the options included. It's very important because not only will you have the options, but you'll have any allowances and incentives as well, and they need to be taken into account. I would also run my margins again when I do my closing and the buyer takes possession, and I would do it 6 months afterwards. The first time we did an engagement related to margins, it was from a longtime builder client of ours who called up and said, I don't understand, when a house is closed, I'm told I am getting, and I'm going to just make up a number, my margins are 20%. And yet, when I go look at my bank account, it doesn't seem to match. And then when I go back and look at some of these homes, it turns out I'm making a lot less money and I need to figure out why. And that was why we originally called in to see what was the difference between margins from the closing and the hard close. So in my scenario here, going back to my 1650A plan that we looked at earlier, this is my original budget at 23% is what I'm going to earn. In my first milestone, when I release this to construction, and I have my accurate pricing in play, I now have dropped down to a 20% return because it turned out that some of my costs were higher than expected. And so that's really important to kind of note that. What I encourage most clients to do who follow this, we would have an extra column with a narrative off to the side explaining the problem that took us from 23 to 20%. My next milestone is when I take this to sales contract, including options. Now, I don't have it spelled out here, but the revenue is actually the net revenue, and it is minus any allowances and incentives. So part of my accounting here is not only did costs fluctuate a little more than I thought, but my revenue actually was less than I had expected. So I went from a 23% return before and a 20% at the time I was releasing my house to 19% when I actually sell it, including my options. In my scenario here, I move on to my fourth milestone, which is my closing. At the time I turn the keys over to the buyer and I give him the keys to the house, I compute my margins as I book it in accounting, and I'm going to end up with a 17% return. In this scenario, 6 months later, after all of the variance purchase orders and any lagging invoices are paid, all of a sudden I've turned out that I'm making 14%. So I can track my margin erosion. And as I said, if I were doing this with a client, we would also have some narratives that would go along to explain where my problem is. In a graphical presentation, because it's easier to see, I thought originally I was going to make better than $70,000 on this house. When all was said and done, I made about $45,000. So my margins just kept eating away as these different milestones came along. So I think it's very important. I think these milestones are true for a lot of people. And then I did a second chart here that you can see, and this just reflects the percentage changes from my original 23 down to my final at the hard close 6 months later. Now, as a follow-on engagement to this, we were hired by the same original builder sometime later, and he said to us, I would like a better handle on my margins, Stuart. I'm being told my margins on my options are X. And once again, it isn't consistent with everything that I'm seeing, so I need a better understanding. And I happen to be very familiar with the system that he was on. And I said, if I take some of your data, I'm going to come back and I'm going to tell you what I think your margins are based on the data in your system. I would like you to ask your team to tell you what they think the margins are and compare them. So in the end, we created this report here. It's a very simple report, but it sort of says it all. We took lot 19 for a community. These are all of the addendums that were written for these descriptions. Oops, sorry about that. These were the descriptions that were done for each of the options. We pulled it right out of the system. These are the codes. We didn't make any of this up. This is the retail value that was being charged. This was the cost based on what was in the system for each of these items, and that included any trades that needed to be included. And you can see here the gross margin for each of these is really it's just simple math, taking the retail less the cost, and then we computed it. And it looks to me like, as he told me in the conversation, he said his margins are upward in 30+%. Well, when I compute it based on the data in the system, for this particular house, it's running at about 11.9%. The same thing is true with lot 20. Right now, this has a house that hadn't closed yet, but it was a spec home. And basically down here, he's making 20%, even though he assured me he knew he was making 35 at this particular lot. And that information came from his team, not from him per se. He was really the messenger, but I'm saying, well, I know your team is telling you you're making 30+%, but I'm going to tell you if I take the data and I look at the cost that you're incurring from the vendors and the revenue you're earning from your sales agreement, I'm not coming up with the same kind of numbers. And I think this explains a lot. Now, in this particular example, we were asked to basically come up with a few other reports, and so that's part of a series of reports. We came up with a margin option report, as you just saw. We also came up with a base house margin report. We came up with base and options incentives, and so on. We came up with a lot of different scenarios, and those reports are now being passed out on a monthly basis in a big management meeting. The second thing we're doing for this particular client as well, and this just started recently, so I don't actually have any actual reports to show you, but it has to do with cash flow. If we are doing better in understanding our sales and our cost of sales and our margins, we should be doing better on our cash flow. In this case, I went back to things that when I was at Ernst & Young that I did, and this goes back to probably better than 20 years ago. I'm going to say 25 years ago. I was very impressed. I used to do hotel audits and casino audits for the firm from the computer standpoint, and I remember probably in the mid-90s, I was at Caesar's Palace in Las Vegas. And it was the early day of the playing cards. And I was kind of impressed, actually, because they, unlike home building, were very high tech. At the time, I had an opportunity, and I just kind of mocked up the way it looked. And what I recall at the time, they had the player card. So if I called up and made a reservation, I would give my player card number and my name. I took the poor Disney folks. They're my attendees, or my players. And they made a reservation. The thing that I was most impressed at the time is if I were Mickey Mouse and I was planning to show up in December and making an advanced reservation, the system knew on average, if I were there for a couple days, that I would lose $32.75 per day. If I were Donald Duck, I would lose $5,500 per day. If I were Minnie Mouse, I'd lose a little over $1,000 per day. And those things ended up right in a cash flow model, and it even listed the players' names. And it was pretty amazing to me because these would go out into the future. So if I made a reservation for the next 5 years and I was going to be going to Vegas every Christmas, I would be in there 5 times for 5 Christmases. And I thought it was pretty impressive back in 1995 that they were to keep track at this level of the players. And the other thing that was impressive about it was not only did they keep track of, after Mickey Mouse would leave, the system would reevaluate what the expected earnings would be the next time he came in. So this number may fluctuate up a little bit or may fluctuate down for his next visit. But it kept very close tabs as to what happened. It also kept a separate notation if there was a jackpot won. So that was not included in the calculation, but it was still noted. And the reason for that, it was viewed as an anomaly. If I won a $12,000 slot jackpot, that was great. Everybody was happy, but they didn't really see that as going to change how much money I was probably willing to spend. So on here, we took this recently in our discussions with the client to home building, because I said, we know when a buyer signs a sales agreement, when he or she is going to close, so we can forecast what the cash position should be. So here the casino did it based on a reservation, and why can't we do it based on the sales contract? So we're going to go ahead and we're building our cash flow model on that. The second thing that was done in Vegas, which is applicable here as well, is that we know that there is a cost associated, and we're not going to get all of that money in cash. And we know that Mickey Mouse is going to get some perks. He's going to get to go to a show, and he's going to have drinks, and he's going to have dinner. And so we also look to not only what the revenue is and what we have, we're going to earn in cash, but how much we're going to spend as Mickey comes out here. And so they would forecast ahead for those days, and the next report then shows the net difference between what he would spend and what it would cost us. And so my feeling is for the projection for the home builder, we can do the same thing here. We have an idea what the revenue is going to be. We have an idea what the cost is going to be. And I should go back a little bit. These here, to me, are equivalent to our allowances, discounts, and incentives. And that's what we would have the equivalent in home building. And then, I'm sorry, if you go to the next one, it would be the net cash would be the difference between the gross sales contract, the incentives that were offered, and then what the net would bring us. And that's exactly what we have here. Now, ultimately, we will have a lower section that will have to do with our direct construction, indirects, and so on and so forth as far as cash is concerned. And that we already have laid out as well in our plan. So even though they're very different industries, I think that they can be treated the same way as far as cash flow is concerned. And this is the follow-on engagement for Cornerstone, and we're pretty excited about it. The last thing here I would like to say, and this comes into my last topic of the day, will be perceived value. This is what Mickey Mouse thinks that he has gotten as far as perks are concerned. So even though he spends $3,000, he sees that he is getting about $1,000 or $983 in perks as far as drinks and dinner and other things are concerned. And I think this is an important thing because as a customer, he wants to feel he's getting value for service too. And at the very end in my third case study, we're going to talk a little bit about that. I'm going to move on. So that was my first case study, and it had to do with gross margins, and I think it's pretty important in the industry. My second case study has to do with buyers' profiles and their purchasing habits. And once again, the key word here is the word data and our data analytics. And here, and I'll just kind of go through these quickly, everybody's looking to understand their buyers. They want to reduce their cycle times. They're trying to increase their bottom line. So all the things that anybody would be interested in. And so what we did in this engagement, in this case study, we took a look at the data that came in from all the various areas, the CRM and sales and purchasing and accounting and warranty. We also looked outside to some of the survey information, census data, third-party social media, and public records. We were trying to get a better idea. As far as each of the different areas, these were things we were looking at, bidding and estimating, national purchasing. So we took in data from all these different components. And each one had its own set of, criteria and its own issues with inconsistency, and some data was better than other data. Some data could be counted on better than other data, but we sort of got through that and standardized across the board. And that's essentially what we're talking about here. So ultimately, we were looking about getting better information for cross-selling, knowing more about our buyers and what they're looking for and how they want to do it. Now, what we ended up doing is we came up with a buyer profile for a community, and this was a live example. And we looked through the marital status and their household, number of children, pets, income, occupation, so on and so forth. And we were able to derive a buyer profile. And from that, we were able to determine what it is this buyer would normally buy. And if you think about it today, when we go onto Amazon or to some of the other websites out there that are selling us things, they tend to make suggestions across the board, and they will tell us, hey, if you're interested in crown molding, you may also be interested in shutters for your windows, and so on and so forth. And we found this to be equally as true in home building. And in our scenario here with our model family that we saw a moment ago, we were able to come up and to predict what a family of 5 in a community with a certain income would probably be looking at. And in the end, what we did is we ended up giving a shopping list to the design center and said, you know what? These are the top 15 things that these people probably will be interested in. So if I were you in the sales cycle, I would go ahead and start with those and kind of push them because they tend to have the highest probability of success. So as I say here, we provided the sales team with a preferred list of options, both structural and design center. One of the things by doing this, we shortened the cycle time, the sales time, because the sales associate was able to make suggestions right up front about things that people would probably be interested in. And we found that we increased the sales by about 22%. And that was pretty exciting. One of the things that it allowed us to do is that we could revise our option catalog and our approach. We also were able to look at our more popular and profitable options, as well as those that we don't really sell and we shouldn't waste a lot of time on. Now, we did incentivize the sales team, and they were thrilled because of the increase in sales and increase of money they were earning, so it was a win-win for everybody. And we found that we got better buyer satisfaction ratings from those buyers that came through. They said the cycle was very simple. They really appreciated the suggestions from the salespeople, and in many of the cases, they actually took them. So we were very pleased with our results. That builder, I know, is using that model to this day, and they continue to do that. And once again, they do it both with structural options and upgrades and design center options. Anyway, my third and my last area of case study that I want to talk about a little bit, also data related. And this just came up recently. We got a call and we became involved with Allowance. And they have their own, and what they do is they do buyer satisfaction surveys. And we had a common client. And it was kind of interesting in talking to them and talking to our client in that they were getting some bad reviews in 1 or 2 of their communities. And during our discussion, I said, you know, if you're getting this on the back end from Allowance as far as the customer satisfaction surveys, I'm wondering what you actually have on the front end in the back ERP system. And once again, it happened to be a system I'm very familiar with. And we went in and we extracted the data. And one of the things that we found here, and one of the complaints that they were rated poorly on, was the sales representative through the construction process didn't communicate very well. So in this example, we picked out poor Ryan, who during the prospect and sales cycle had 88 forms of communication with his would-be buyer while he was selling something to them. And that includes phone calls, emails, text messages. But once the buyer became an actual buyer, or once the potential buyer became a buyer, during the construction cycle, he only had 15 bits of communication between them, and it was not running very well. And he was rated very low as far as his communication skills during this part of the process. And so once again, this information was in the back office system, and it was consistent with the buyer satisfaction. So in talking to the builder, he said to me, well, hey, why don't we do something about this before it gets to the point where he writes us a bad review? And I said, exactly. I said, well, I can easily give you this report that shows you how to monitor that. And we ended up doing that. Now, this is just a quick line. It just shows what happened. Same scenario. There was dissatisfaction at a higher rate than other communities, and we were able to determine by the back office system there was consistency of those salespeople that spent more time or less time communicating with their buyers. Now, one of the other things that we did point out in the particular software that they were using, because we're familiar with most of the leading softwares, it has the ability to communicate through automation directly with the buyer. And in this case, and these are just screenshots, you can set up a rule. In our case here, we said we're going to send a note when the task code equals slab pour. So basically, when a superintendent was to check off on his or her schedule that the slab pour was completed, an email would be shot off to the owner letting them know, and you can put whatever verbiage saying, hey, guess what? Your slab has been poured. We are moving on to the next phase. We're really excited. You could do it for permits. It's in the schedule, or you could do it for paint, or you could do it for foundation or roofing or framing, whatever you want, but at no additional cost. This is part of the base product, and once again, that drives me a little bit crazy that people don't really understand their products well enough, and they have that ability. Now, the other thing you can do too, since most of the systems are Microsoft-based, is that there are Microsoft integration tools that will do the same thing. Most people actually have them, just don't know they do, and they could easily create their own world. In this case here, once we did make some of those changes and once we set up those notifications, we did see that the buyer survey satisfaction results went up. And it was really just a matter of turning on some functionality in the base system in order to do that. So no hocus pocus, no custom programming, no $1 million in consulting fees. We just set it up and off it went. The two other things that we were able to correlate, one had to do with the customer satisfaction as far as deliveries. In the case that we were looking at in the data, the customer survey score was very low. When we went into the data, we saw that there was slippage of more than 30 days as far as what was promised on day one for delivery. And as the owner said, well, I can't believe nobody told me we were having that kind of slippage. And I said, well, we can have the system notify you directly if nobody is telling you that. And once again, his back office data was consistent with the review that, yes, he is slipping, and yes, he is 30 days behind on his delivery, and yes, it is irritating people. The other thing that we found when we were looking at the data on both sides, they were rated very low on the number of deficiencies and the time it takes to fix them. And once again, the owner and the president said to me, I had no idea. And I said, well, your back office shows that these are the number of reported walkthrough punch list items that happen when the buyer comes in. And once again, we were able to correlate that data. And once again, he has been able to improve his scores. So once again, I was hoping not to bore you today with debits and credits. I just wanted to give you some case studies. I think that it's very important for people to appreciate what they have, what they could do with it. And in my experience, it will help improve the bottom line because you'll run more efficiently. And that is my word for today. So I'm going to open it up to any questions that you may have. And I'm not sure how to do that, so I'm hoping somebody at Hyphen smarter than me will know how to do it.
Absolutely. Thank you, Stuart. That was great. We do have a couple questions for you.
Okay.
First one looks like it's around gross margins. With the builders that you work with, do you feel that every builder calculates the gross margin the same way?
No, and I think I mentioned that a little earlier. It's one of my beefs. A lot of times, it's a little bit like nobody really knows how much anybody is worth or, how much money that they have, and some people like to pretend they have more than others. The gross margin is always a mystery. It is very interesting to me because that's one of the first things that owners and presidents like to tell me what his gross margin is or hers. And I always like to know what makes up that number, and I like to take a look at it because I don't see any consistency at all. I wish the National Association of Home Builders would come out with a standard and say this is our recommended standard for defining gross margin, so that way people could compare across the board from one to another.
Excellent, thank you. And the next one is, do you feel that the builders that you work with offer too many options? And if they do you feel that that increases the sales cycle?
Yeah, one of the beefs that I have is that I think that builders try to offer a lot of options and flexibility for their buyers, but I think through their own data, if they took a look at which ones they actually sell and how many of them, I think they'd be surprised. There really is a core group of options that are sold over and over again, and yet they maintain this huge database and they have to change all the pricing and the model numbers and all the rest. And I think in the long run, it's not really worth the time and effort. So I would really recommend that somebody go in and clean out their closet and take a look at that. I think it will speed up the sales cycle time, and I think it will also help the back office because they will not have to price a lot of things that you're really not going to sell.
Excellent. That is our final question for the day. And again, this will be shared with all the attendees and registrants. And if there's any questions, there's Stuart's email along with my email, as well as Stephen Candy's, our division president, was on the very front end of this presentation. But we appreciate everybody's time. Stuart, thank you so much for the time. It was a great presentation, and we look forward to seeing everyone at our next webinar next month. Thank you again, Stuart.
Thanks, Matt. Bye, everybody.